Investing sounds simple until you hear words like stocks, bonds, ETFs, real estate, and your brain shuts down. If you've ever wished someone would just line up the main investment types and explain them in plain English, this video is for you. In the next 7 minutes, you'll see the whole investing landscape on one simple map. Quick disclaimer, this video is for educational purposes only. This is not financial advice. Imagine 4 big buckets. The first bucket is ownership investments. Things where you own a piece of something that can grow in value, like stocks, stock funds, and real estate. The second bucket is lending investments. Here, you're essentially lending money in return for interest, like bonds or certain bank products. The third bucket is cash and cash-like, savings accounts, high-yield savings, money market funds, certificates of deposit, or term deposits. And the fourth bucket is other or alternatives. Things like real estate investment trusts, commodities, or even speculative assets such as crypto, which many people treat as separate from their core long-term investments. As we go through, try to picture which bucket each type belongs to. Let's start with individual stocks. A stock is simply a small piece of ownership in a company. When you buy one share of a company, you own a tiny slice of that business. Imagine your favorite coffee chain. If you owned one share, you'd be entitled to a tiny portion of its profits and assets. People use stocks when they want growth over a long period of time and are willing to accept ups and downs along the way. The risk here is that a single company can do very well or very badly. Prices can move a lot in a short time. A common beginner mistake is putting too much money into 1 or 2 companies they've heard about on social media without understanding the business or the risk. Keep this idea in your head because stocks are the building blocks for a lot of other investments we'll talk about next. Now, what if you like the idea of stocks, but you don't want to pick individual companies? That's where stock funds, index funds, and ETFs come in. A fund is like a basket that holds many different investments inside. When you buy one share of a stock fund, you're spreading your money across dozens, hundreds, or even thousands of companies at once. Some funds are actively managed by professionals, others are index funds that simply track a list, like a major market index. ETFs, or exchange-traded funds, are just funds that trade on the stock market like a single stock. Why do people use them? Because they can provide instant diversification and are often simpler for beginners than trying to pick winners. The risk is still there. Markets can go up and down, but the risk is spread across many companies instead of just one. A common misunderstanding is thinking a fund is safe. Just because it's diversified, it can still lose value in the short term. After stocks and funds, the next logical question is, what if you'd rather be the lender, not the owner? That brings us to bonds and bond funds. A bond is basically an IOU. You lend money to a government, a city, or a company, and in return, they promise to pay you interest and return your money at a set date. Imagine lending money to a city so it can build a bridge. In exchange, you get regular interest payments. People use bonds when they want more stability and income compared to stocks, especially over medium to long time horizons. But there's still risk. The borrower might struggle to pay, and bond prices can move when interest rates change. Many investors use bond funds, which bundle many bonds together instead of buying individual bonds. A classic misunderstanding is thinking bonds can never lose value. In reality, they can drop in price, especially if you sell before the maturity date. So, if ownership and lending are one side of the map, what about the safest feeling corner? Cash. Cash and cash-like investments live in that third bucket. This includes regular savings accounts, high-yield savings accounts, money market funds, and certificates of deposit or term deposits. Here, you're usually accepting lower potential returns in exchange for stability and easy access. Think of a high-yield savings account as a parking lot for money you may need in the near future. A CD or term deposit is like saying, I'll lock this money for a set period in exchange for a fixed interest rate. Many people use these for emergency funds or short-term goals. The main risk here isn't big price swings. It's more that your money might not grow as fast as inflation over long periods. A common mistake is leaving all long-term money in cash because it feels safe without realizing that its purchasing power can slowly erode over time. So where does something physical, like property, fit in? Real estate is another key investment type in the ownership bucket. When you buy a rental apartment or a house as an investment, you own a physical asset that can potentially generate rent and may change in value over the years. The appeal is tangible ownership and the possibility of combining rental income with price changes over time. But real estate also comes with its own risks and responsibilities. Maintenance costs, vacancies, and the fact that property is not very liquid. You can't sell a house as quickly as a stock. For people who like the idea of real estate but don't want to manage buildings, there are REITs, or real estate investment trusts. These are companies or funds that own many properties, and you can buy shares in them, often through the stock market. A beginner mistake is assuming real estate always goes up or is risk-free. Like any investment, values can fall, and leverage can magnify that. Finally, let's touch on alternatives and more speculative assets. This bucket might include commodities like gold or digital assets like crypto. Some people use these to diversify or to speculate, hoping for higher potential returns, but accepting that prices can be very volatile and unpredictable. It's important to understand that many long-term investors treat these as a small, separate part of their overall picture, if they use them at all. A big mistake beginners make is putting too much into something speculative they don't fully understand just because it's popular online. Whenever you hear about a new hot investment, a good question to ask yourself is, which bucket does this belong to, and how stable is it really? So how do these pieces fit together for beginners? In a very general way, many long-term investors build a mix of different types. Instead of betting everything on one, they might combine ownership investments like stock funds or real estate with lending investments like bond funds, and keep some money in cash-like accounts for emergency needs. The mix often changes with goals and time horizon. Money needed soon may lean more toward cash and safer assets, while long-term goals may include more growth-oriented investments. The key idea is diversification, spreading your risk, keeping a long-term perspective, and matching the level of ups and downs you can emotionally handle. As you think about your own situation, remember that everyone's life, income, and local rules are different. Fees, taxes, and regulations can vary a lot between countries. That's why it's important to read the details of any product you're considering. If this video helped you, please like and subscribe for more.